My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people want to make friends. I'm just trying to make you some money. My job, it's not just to entertain, but to educate and teach you. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. We too often invest for the day. I hear people talk about what is working. And in the old days, when the late, great Mark Haynes ruled the mornings around here, I remember that each time I co-hosted, he would introduce me as Reverend Jim Bob Cramer from the Church of What's Happening Now. Oh, it was fun back then. It seemed like everyone was running their own personal hedge fund. There was an understanding that a stock could be here today and gone tomorrow, and everyone was fine with it. Those days are long over. And if you recommend a stock for a trade, even if you say buy it today for the analyst meeting and sell it tomorrow, sell. There will always be a YouTube video kicking around that shows you liked the stock, but never gave it the sell call. So we've gone well beyond that. Tonight we are taking it to the next level, where I'm introducing you to the concept of suitability. Basically, what stocks fit you? What investments are right for you? Not for this week, not for this month, but for your age and your temperament. I first heard of the concept of suitability when I was in training at Goldman Sachs for the group that helped small institutions and individuals. I had been buying individual stocks for myself and for others for a half decade before I got to Goldman in '83 as a summer intern. At the time, I was watching Financial News Network between classes at Harvard Law School. That was the predecessor to CNBC. When I could, I'd run over to the Harvard Business School library, where they had old research reports from long-gone firms like Bache, Shearson Lehman, about stocks totally on a catch-as-catch-can basis. It's so nostalgic to look back to what I would do next after I found a stock I liked. I would ask the kind librarian for a microfiche of the firm's SEC filings. These were little pieces of plastic you stuck into a machine, and you read the filings, all which you were lucky enough maybe would be only 6 months old. Everything I did back then is now online and instant and updated. The imperfections in the market back then were legion. Now everyone can know everything, but more on that later in this show. I would spend all week trying to find one stock that I thought would work, one stock that would be good for 1 week, where anyone who wanted to invest could take the idea and then run with it. And then I would take my answering machine and give you a 20-second wrap on that stock. Answering machines, can you imagine? Some companies used to make them with all those jobs wiped out by your cell phone, right? Answering machines. Same with answering services, for that matter. Talk about jobs that aren't coming back no matter who's the president. Anyway, I would say, hi, this is Jim. I'm not here right now, but I like both the chart and the recent numbers from People Express, a long-since bankrupt airline that I used to jet down to New York for job interviews. My best one? A recommendation for Monolithic Memories, a smoke show of a company with a red-hot stock that was run by Zev Druria, who 2 decades later helped save Tesla back when that car maker was struggling. Yeah, Druria, in 2007, 2008. He was the last CEO before Elon Musk. Anyway, Monolithic shot up like a rocket that week, and ultimately it ended up with a big bid from Advanced Micro Devices. That was far down the road. It was the best Kramer's Not at Home call his machine hit I ever had. And believe it or not, Jim is not home became a rallying cry for lots of people who were calling me back then, hoping I wasn't home so they could get the tip without having to deal with me. Not long after I got a job at Goldman Sachs, one of the officers at the firm called me and got the machine with its recommendation. He told me to call him as soon as possible. I did, and he asked me if I knew what suitability was. I had no idea. Suitability. I mean, like, how's my suit fit? I didn't even have a suit. So he introduced me to the concept. He asked me, did I ever consider that many people who called me and got my answering machine might not be ready for the stock of the hottest semiconductor company in the land, and that I was recommending it to them one-on-one without any sense of whether it was right for them? I said that I always thought that stocks were pretty much a caveat emptor situation. We all know that unlike, say, vacuum cleaners, you can't take stocks back. They come with no guarantee, so what's the deal? The executive explained to me that before you recommended a stock on a one-to-one level at a registered brokerage house, you had to know what that person wanted, what he wanted out of a stock. You wanted to know if the stock was right for them and for their tolerance and risk. Monolithic memories, he said. Yeah, monolithic memories. Wasn't exactly the right for anyone other than bungee jumpers and K2 climbers or something like that. It's a long time ago. So let's start there. Tonight I want you to ask yourself, what is your risk tolerance? How much risk do you want out of a given stock? You see, stocks are pretty peculiar pieces of merchandise when you think of them. You buy a car and you know it's not worth as much as when it leaves the lot, right? I mean, the moment you take it off there. But there are all sorts of warranties. You buy a house and you know that it could burn down the next day. However, before you buy it, you get a binder with insurance, so if it does burn down, you get your money back. Clothes can be returned, devices returned, phones, PCs, washers, dryers, you name it. But stocks? Stocks. You buy a share of Nike and the next day Goldman Sachs downgrades it, and the day after Foot Locker says there's been a slowdown in Jordans, you can't go back to your broker and say, hey, Chief, you never told me this could happen. I'm down $3 in 2,000 shares. I'm out $6,000. I want that $6,000. I want it back. Caveat emptor. Now, it would have been incumbent upon the broker back then when I got started to recognize that the buyers would know these things could happen. Maybe the broker should never have been recommending stocks to begin with. No matter. You get the point. Because you can't take stocks back and get the stock price, the same price that you paid, because there is no real insurance, although you could buy an expensive put underneath with a cost that lowers the return of Nike pretty dramatically and has to be renewed constantly. Suitability. The concept of suitability is incredibly important. That's why for the next hour, you're going to learn about a way to measure your own tolerance versus a variety of factors. Because these days, with electronic brokers, there's no real protection. Just a signed form that say, you get it. You know what you're getting into, and you accept it. Tonight, the bottom line, that stops here. By the end of this show, you will know what suits you and what doesn't, no matter what your age or your style. Or to put it this way, caveat emptor? No. Just buy or be a little more aware of what you might be committing your hard-earned dollars to when you pull the trigger on a buy. Buy! Anne-Marie in New York. Anne-Marie.
Hey, Jim. Thanks for taking my call.
Of course.
Can you talk a little bit about trimming our profits? Because I get eager and I start trimming when I'm up 10 or 20%, which I know you'd say is a high-quality problem, but can you talk a little bit more about the trimming?
It is a high-quality problem, but what would happen if you kept doing that was that you would miss out on some of the greatest stocks in the history of man that you may actually own. What I suggest you do is move that up a little. I don't think you should start selling till you're up about 25, 30% and only sell about a quarter position. When you're up about 60, 70%, this is a change from the old days. I think then you should sell a little more, but then you got to let it run. And if it comes back, you can buy some. I just don't want you to lose a great opportunity unless the story changes. And then it's sell. Immediately. Lido in Texas. Lido.
Hey, Jim. How are you doing?
I am good. How about you?
My question is, as a recent early retiree and one who is anticipating, a possible market correction in the near future.
Okay.
Should I allocate a stock index fund now from a stable income fund, or should I wait until after the market has corrected?
No, I mean, if you're in retirement stage, I still want you to own equities, but I don't want you to have as much equity exposure. You really should own more than 50%. That's actually a lot if you're retired. Now, I want you to own some, obviously, because people who retire tend to live 20, 30, 40 years longer than they thought. But no, I mean, taking the cash out, don't necessarily put them in bonds when interest rates are higher. But you know what? You'll put money back if the market really craters. Otherwise, I think you'd be fine, and you got to let it ride. Marlo in Illinois. Marlo.
Jim, you talk about index funds. Can you please tell us the difference between index funds and ETFs and maybe give us a couple of examples?
Well, there's not much there. It's different. What I want you to do, I always default to what Warren Buffett says. Warren Buffett says you should buy the Vanguard Index Fund. It's the lowest cost fund. Vanguard's very easy to get to. I just want to go with Warren Buffett, the greatest investor. Why? Well, Warren Buffett, what am I going to do? Argue with him? That's never been a great call. All right, no more excuses. I'm helping you form the necessary investing strategies you need at all stages of your life tonight. From young to old, I'm going to meet you where you are and take you where you need to be. On Mad Money tonight, we're kicking things off by beginning in the crib. Forget binkies. Here are the two stocks you should be buying to give a newborn a much-needed head start. Then teenagers typically have a lot to learn, but there's an important investing lesson everyone can get from them as well. I'll fill you in. Plus, from your 20s to your golden years, my definitive guide to where your money should be sitting at any age. Stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.